Welcome everyone back to another video. Today is Friday, the 28th, and it's 9:43. I'm going to start off with I hope you guys had a wonderful week, and I'm gonna, of course, update you guys on how trading's been going this past week. Not the best, but I'm still open to staying consistent with these videos that I do every week about my journey. And this month actually has been worse than January, but I'm still going to share these things with you. Update, I finished my other book. This book, I started reading Mark Douglas, The Disciplined Trader, and I'll give you guys like two quotes that I've, I've, I think it's something that we all need to hear as traders, especially the ones who are starting out. I'm going to share my screen so that you could see the quote that I'm referring to. So the first one is all the traders I knew, including myself, were affected by this type of big trade mentality. In fact, okay, so anything otherwise might be perceived as a problem because the next trade always had that in one's life seem irrelevant. Why deal with anything if the next trade can make you rich? I should have highlighted this one too. But yeah, overall, the first quote is, why deal with anything if the next trade can make you rich? All the traders I knew, including myself, were affected by this type of big trade mentality. So this type of mentality is something that I think all of us struggle with. We have this is a challenge in our life as a trader because we think we're gonna, be one of these like we probably have we think in terms of probability. Obviously, we think in terms of probability. And when you use the reason of probability as a reason for you to say, I mean, I got like $300 in this account. I can make $300 again. Why don't I see this as a potential move that can make me 5,000. Why don't I just risk it all? And that's really realistically, you're not learning how to trade like that. The most important thing here is really not about us making all the money that we can make. It's more so what's most important realistically is the skill behind trading, the consistency, the discipline and just just reps, the reps. Reps is the same as consistency, the discipline, and skill, because you have to be a skilled individual in order to be a successful trader. And you can't be, which means that you're gonna have to find an edge and stick with your edge. The second quote is, at that time, it felt as if the market was insulting me by offering such paltry sums compared to what I needed or expected. To put this into perspective, I think this is something we all likely struggle with as well. Um, let's say you make $80,000 per year. Uh, Matter of fact, let me make it easier. Let's say you make $52,000 per year. So if you make $52,000 per year, is 52 weeks, which means you make about $1,000 per week. Now, you're most likely going to, as a trader, walk into the markets and expect the markets to pay you $1,000. You're gonna attach people like traders will most likely, I am guilty of this as well, attaching the idea of what you make outside of trading, and you'll often think that that's your worth from the markets as well. So if you're making $52,000 with a job or wherever else outside of the markets, then you may likely come to the markets and expect the markets to hand you $52,000 per year as well, or $1,000 a week. Um, in other words. So these are two really big quotes. This is an interesting book that I just recently started reading, like middle of this week, probably like Thursday. Uh, I it's really good so far. Highly recommended. It helps with your mentality and it helps with also before you get into a trade, you start to think of certain quotes in the book. Like it's almost like holding yourself accountable, or you can look at Mark Douglas as your accountability partner. Unfortunately, this week I regardless of the videos I've watched from Mark Douglas so far. I started like I'm gonna just share with you guys how my week went and I'm trying to look for the thing to start sharing my oh yeah. Yeah, I'm disappointed in my trading this week. I know it'll get better. I just have to I'll mention something after, but yeah, this month has just been even worse than January. Like, if you look at the trading days, so this was January. Um, what, 4 or 5 green days, about 10 green days, and then so I took 5 steps forward and then I took 6 steps backwards. 4 green days. This is just this is unbelievable. But you can see I went a little bit more down in the hole. Now I'm down negative 2,000 from January since January started. So that is crazy. That's actually rising. Yeah, that's not good. But yeah, what 16, 17, 18, 19, 20, 21, so 28, 29, 30, 31, 44, 50 trades. So I went back up to 50. And you know what added to me what I know for a fact what added to me um trading more this week was because I still had different pairs. So I had like, UJ, GJ, or UJ. I can't remember what I can probably look at my last YouTube video to look at the video I said videos to look at how many other trades I had in my trading view, like dashboard on the right side. But what's helpful is minimizing the amount of pairs. Like I never wanted to minimize the amount of pairs that I see. Okay, I see okay, so this is 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Okay. So I had 12 different pairs on my last video. And I find that having less in your, space, it's actually more helpful than you think. Like if you haven't minimized the amount of pairs that you trade to just focus on one, two, or three maybe at most. I'm not sure. I haven't really like done this before when trading. I always like have a plethora of different options on my screen to maximize the opportunity is what my in my head, which I got to get out my head. And another thing I got to stop doing is being arrogant with my risk management. So lately I've been risking 5, 10%. Like, look at this video. I've been saying, okay, like B plus setup, 5%. A plus setup, 10%. So with me not even showing consistency, I'm here having 5 to 10% risk on my trades, which it's not about the profit, it's about the process, which is what I'm working on. So another thing I'm working on is my next goal is going to be, so in fact, what I'll do is I'll show you guys all that I have on my screen now. So instead of having, how many did I say? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Okay, so instead of having 12, I'm gonna only have two. It's gonna be gold and US 30. So with gold and US 30 being the only pairs on my screen, I'm gonna stick with 5% and I won't go to up to 10%. I'm only gonna do 5%. I wrote this down in my notes. So 5% per trade. I'm no longer really trading from like the weekly time frame. However, when Sunday starts, or I mean, I can really tell the direction from like starting now. Like if we were to go to weekly, we can see that the weekly time frame is bearish. And if we were to go on the weekly for gold, it's bullish. So I really don't have to do too much type of homework on the weekly time frame. Daily, daily's bullish. Uh, Daily's bearish. I would imagine this is bearish because I was initially saying this would be the high and this, of course, would be the low. And what happened is, yes, the 4 hour time frame went bearish this week. What happened is price went like that. Man, I don't know. Okay. This week price went from here to here to here. On Monday, Tuesday pulled back. Actually, this was last week. Either way, price came here, uh, came here, here. Actually, that doesn't even count. Here, 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 uh, here, 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 here. So this is the market structure for US 30 on the 4 hour. So we can see that the 4 hour shifted because of this right here. Well, not only this right here, but also it was creating lower lows here. So these two right here indicated that 4 hour time frame shifted. So we had two market structure shifts right here. And we also closed below this one right here too, which was a major one, a major key level. So being that the 4 hour is bearish, only looking for sells for US 30, that's a part of my strategy. Would also be to stick with the 4 hour direction. Do not go against the 4 hour direction. what, and because I took so many L's, um, I think what I should do is not even, because I think when you go against your trading plan, it gives you, and then you give yourself like a penalty, which I just don't, I don't know, maybe it depends on the penalty where you wouldn't engage in being an undisciplined trader. Like, I just don't find that it gives you to be a disciplined trader. It just doesn't make sense because you don't want to put the idea in your head that, oh, well, this is a small penalty. So, I mean, like, I don't want to do the penalty, but, let's say if you're doing a $300 account and you're like, I'm gonna risk 100% of the account, and then you just lose, 300. And the penalty is like a minor penalty. It's like, was it worth 300? Like, was it worth to blow your account? And then now it could even be a cycle, you know? So you don't even want to really give that habit. And I just think the whole penalty for yourself just really gives you an out to be an undisciplined trader. It's like, why even be undisciplined to begin with? So I'm not really gonna not incentivize, but take advantage of like giving myself penalties if I go against my trading plan. All I want to do is go with my trading plan. So I would say one of the things a part of my trading plan would be sticking to the 4 hour direction. I was gonna say directional bias, but 4 hour direction. Another thing would be only, this is kind of the same idea, but it's only trading internal to external. So let me show you. So internal to external would mean, let's say the market is, oh, I'm gonna have to redo this. Market is red, it's bearish, and the time frame would be, let's say, daily time frame. Now, if you're on the daily time frame and you see price do this, starts creating some higher highs, and then for whatever reason you think, price is going to sell somewhere here, obviously because the daily's bearish, and for whatever reasons that you have in your strategy to believe that there's enough people in here to, or whatever type of reasons you have for why you think this is an important key level for price to go from here and for you to short it. What do you think this is? Is this internal to external, or do you think this is external to internal? If you think this is internal to external, you're right, because this is the inside of the move and this is the exterior of the move, which means price would go from here and then do a significant drop, slow drop, fast drop, significant drop, whatever. Price doesn't always have to get, just go straight down. Price can do whatever the hell it wants. Price can go here, 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 back here, and, you know, even come back here, take out, people and then, hit your TP. So let me label this one. This is internal, whoa, to external. Now, if it's, let's say this was the opposite. If we did external to internal, then external to internal would look like this. Market creates, market starts creating higher highs. Now you think it's a good idea to say, I'm going to target the whatever major key level because I know that we're most likely this week gonna retrace. Like you might think price may retrace since it started creating higher highs into your key level here. And then, just because you think that you're gonna also sell from that major key level to get two trades, so knock a bird with one stone, two birds with one stone to profit more, right? You're gonna say, hey, this is from here a 1 to 10, and then from here this is a 1 to 7. So this essentially is a 2 to 17 uh risk to reward. And I mean this is how I think or have been thinking. But realistically you're gonna see the probability of this happening um is lower than trading with the trend. Once you trade against the trend, naturally, your risk to reward is not going to be where you want it to be. Trading with the trend, you have a higher probability. Markets are more in your favor to go with your directional bias. So I'm going to stop doing external to internal and focus on internal to external. This should definitely help my win rate, but also my, edge, I guess, external. Win rate, edge, maybe even my psychology, because psychology here, your mindset is what's most important. Not that this isn't a good idea to do external to internal, but right now my goal is to master just one thing. All I need to do is master one thing. All I need to do is stay consistent with one thing. Um, And who knows, maybe two pairs is still overdoing it, but I know there's always opportunities too. There hasn't been any like 1 week that I have not seen an opportunity in the markets, but I think, I think 1 to 2 pairs is I would say I'm grateful for having, one pair, but I'm also grateful for 2 pairs. You could say that for as many pairs as you want, but uh just to change things up, the reason why I want to minimize the amount of pairs that I've been looking at is because it also minimizes the different biases that I might have in the markets. Like, for example, if you look at my other video, you could see that I had certain pairs that I should probably not even have on my screen. I had XAU USD and XAG USD, I think. And it's like some things like I probably shouldn't have had two XAU like gold pairs on my screen because that could have conflict of interest if one looks like a buy and one looks like a sell. And it's just, it's a bad idea. It's really a bad idea. Now, the DXY is should be helpful with understanding what direction gold wants to move in. So when the DXY US, dollar index goes bearish, then we should expect for gold to go bullish. And then when DXY goes bullish, we should expect gold to go bearish. So I think this is a solid um system to have in place. It should be easy on my mental, 'cause I know when I have like ADD, so it's like if I start to have so much information in front of me, I might see, USD JPY, XAU USD, and Euro USD. Maybe two of them look like they're gonna buy, another one looks like it's gonna sell. Then I'm at a point now where I'm like, well, what's the point of even having three different USD pairs on my screen? Because the minute you see USD JPY is bullish and you see Euro USD is bullish, now you're like, okay, well, let me just paint the picture for you guys. If Euro USD is bullish and USD JPY is also bullish, then this is where the conflict comes in because now that means that you're saying the US dollar is bearish, if that makes sense. So you think euro is beating the US dollar right now, but you think that the US dollar is winning, but the Japanese yen is losing. So you have this means that you have two ideas that could be a conflict of interest. And this is what I've had conflict of interest like this so many times. So I'm like, okay, you know what? Let me minimize because now I'm in a Euro USD trade. I'm in a USD JPY trade, and I'm like, okay, well, USD is bullish, but it's also bearish. So should I stay in both of these trades? Should I not? Should I just let it run, see what happens? Should I just go to sleep? And it's like you don't really want to think like that because it's not helpful for your strategy. It's not helpful for your mental. It's not healthy for you. It's not healthy for you long term. And it's like all these extra things that, is just unhealthy. So it creates anxiety. It could create depression. So it's like, you know, in order for us to minimize exiting our trades too early, conflicts of interest, external conflicts of interest, internal conflicts of interest. It's much easier to just choose one, like even if you don't want to go down to like, one or two, maybe it might be helpful for you to just go down to like, GBP, USD, EURCAT, like EU or EC, Euro, Canadian dollar, like where there's not, two conflicting parties, currencies that, in the mix with both pairs. It's not helpful. You also like you want to visually understand and see the markets for what they are. And at any minute, like biases can change. So just focus on what's in front of you and you don't want to look back too far is what I'm also learning. You don't want to look back too far, meaning, well, price here on the 4 hour was high, low, then low, then high. And just because you see a whole bunch of, you might call it imbalance and stuff like that. Just because you see so much imbalance, like it doesn't even mean that price has to come here. Like price doesn't have to come here. Price, if it really wanted to, could, could have went here and then started just creating more highs. So some people obviously probably thought this right here, when the market was right here, it was probably gonna start selling off into maybe 50% of this move right here, which it doesn't have to. Price can be as expensive as it wants to be. Price can also be as cheap as it wants to be. So that's pretty much what I wanted to discuss. Um, yeah, I mean, that's pretty much it. Is there anything I'm missing? I don't think that I'm missing anything. And if you guys have any questions, just comment, do what you guys do, like, comment, subscribe. Hope this video was helpful for any of you guys. Thanks for watching, and I hope you guys enjoy your weekend.